Hello there. Well, frankly, 2022 has been a pretty horrible year for investors. And in fact, lots of the stock markets around the world now are in an official bear market. So a bear market is officially when stocks are down by more than 20%. And that is what we've seen in the last couple of weeks with some of the markets around the world, notably the main US stock market, the S&P 500. But I do think it is worth remembering that bear markets aren't uncommon. In fact, on average, over the last sort of post-war period, they've happened every 5 and a bit years. And usually they don't last that long either. Often 12 months later you find that the markets have actually recovered and you actually get some pretty decent return once a bear market's been triggered. And in the written edition of the Pulse this month, my colleague Neil Foundley goes through what has happened in some previous bear markets. But what has been unusual is that at the same time as stocks have been falling, we've seen other asset classes go down as well, for example, bonds. And so it has been very, very difficult to find anywhere that has made money so far this year. One of the few asset classes that we found that has been positive this year, where we've put some of the money, has been infrastructure. And infrastructure tends to do well when inflation is going up, and that's one of the reasons we've tried to put more money there. But it has been, no doubt about it, a very difficult time to invest. So what's happening and what do we do from here? Well, as we've talked about in previous editions of the Pulse, what's driving the markets lower is a combination of three things. It's concerns about high inflation, about interest rates going up, and about the economy slowing and perhaps even going into recession. But we think it's very difficult for all three of those things to carry on going in that direction for very long. If inflation stays high, then that's going to have an impact on the economy, because we all know that our kind of energy bills and all the essentials are going up, and that means we've got less money available to spend elsewhere. But if we do go into a slowdown or even a recession, then I also think that has a natural, almost dampening effect on inflation, because that lower demand for goods and services naturally helps to bring prices down. And it also would be very, very brave, shall we say, of a central bank to carry on putting up interest rates into a recession. Hopefully, what actually happens is that some of the inflation figures maybe surprise the opposite direction and come in slightly lower than people expect. And then perhaps might even avoid a slowdown. Either way, I think if just there's a slight improvement in one of those issues, inflation, interest rates, or the economy, we could well see a bounce in stock markets. So what we've tried to set out in this month's edition of the Pulse is some of our thinking around what asset classes might do well in different scenarios. What we think is the most likely scenario is that we do get an economic slowdown, but that inflation starts to slow down, or at least not grow as much. So we don't necessarily mean that prices will come back down, but of course inflation is always looking at the rate of change. So there's a very good chance it will be above 10% at some point this year, particularly when the energy price cap is changed. But for it to grow again 10% next year, then prices have got to carry on growing at the same rate they've been doing. For example, the oil price has doubled over the last 12 months. Is it going to double over the next 12 months and be $240 a barrel? I don't know, but to me it feels unlikely. So if we're in a period where inflation is still high, but is now maybe moderating or slowing, then there's different asset classes that might do well if a period when inflation is carrying on surprising to the upside. And we set out some of those in the table within the Pulse. But we think in that scenario, if inflation just starts to moderate a little bit, interest rates might not go up as much as the market's already got priced in. So bonds might do quite well. Things like the technology stocks, which have been hit by both growth and rate concerns, may then rally. So we've been just adjusting the portfolio a little bit to put some more of those sorts of things into the portfolio and top up at what we think is a good entry point. These, as always, when we're looking at markets that have gone down, well, we can look at it another way and say, well, things have got that little bit cheaper, and that improves, in our view, the long-term expected returns. So there's no hiding place, for saying it's a very difficult time to be investing at the moment. But we still have a positive view, and we think actually now is a very good time to top up if we can take that longer term approach. So thanks very much. We'll see you again next time.